In this section, we're going to discuss how prices move and who the players are behind it. When you understand how traders make prices move, then how you need to think to generate consistent results will start to become clear to you. Okay, where we're going now is that I think what I said when we, just before the break, is that when you guys understand the nature of price movement and how any technical methodology that's based on a mathematical formula or a price pattern interacts with that movement, when you understand that relationship, how you need to think will become self-evident. Do you remember me saying that? Okay, this is the part that we're going into right now, okay? In other words, where you understand just exactly how prices move. Because what I found in doing these workshops over the years is that here I'm addressing a group of people who trade and who in many cases have traded for years. And if you ask somebody exactly how do prices get from one price to the next, they can't tell you. They don't know. They don't know how it happens. And maybe you guys are, I'm sure you guys aren't that group, but we'll, you know what we'll do? We'll go over it just as a refresher, okay? we'll do it as a kind of refresher. So, oh. No, actually, I haven't addressed a group yet that there were very few people, or if anybody, could tell you exactly how prices move from one price level to the next. So for an example, 10, 9, 7, 6, 11, 13. Okay, if the last reported price that you see on your screen of something is 10, how does it get to 11?
They asked 12.
What?
They asked 12.
Who's they?
Market maker.
The market maker asked 12, okay? Well, no. Well, okay, it's at 10. How does it get to 11? How does the price actually move to 11?
More buyers.
Well, more buyers, but that's true. But then again, when you what's that? Demand, okay. But when you look at 10, what you have is you have offers at 11 and you have bids at 9, right? Everybody understands that? Okay, now, there's only two ways that anybody can make money in this business. There's only two possible ways, no matter what strategies you're employing, no matter how elaborate they are, no matter how simple they are. You have to be able to buy something at a low price and sell it back at a higher price, or sell something at a high price and buy it back at a lower price. Are we in agreement on that? And would you also agree that everyone that trades is trading to make money?
Yes.
In other words, I'm going to say that there isn't anybody who puts on a trade that does so knowingly and consciously thinking it's going to be a loser. In other words, where they go into the market and say, my purpose is to lose money. Okay, you guys with me on this? Now, if the only way that you can make money is to buy low and sell high, or sell high and buy low, and the last price, posted price, is 10, which represents the value at that moment, then what's low? 9 is low, and what's high? 11. What's the only way that it can get to 11? Somebody thinks 11 is a good price, meaning that they have to buy high relative to the last price, right? So for an example, so basically what this also means is that all the offers have to be taken out at 10, do they not? Anybody who had an offer in at 10 that wanted to sell at 10 will get filled, and all those offers have to be taken out for the price to go to 11. Correct? And of course, and for the price to go to 12, all the offers that exist at 11 have to be taken out so that someone could actually bid the price up to 12. For prices to move, somebody literally has to bid the market up. Or for prices to go lower, it means that someone has to offer it lower. Now, if the only way that anyone can make money is to buy low and sell high and buy low, why in the world would anybody bid the market past the last posted price?
Because he thinks he got a winner.
Conviction, exactly. Conviction. In other words, what you have is a situation where on every trade that exists, there are two people on both sides of the trade. Even in stocks, there's even someone who's selling a stock, not like a commodity where in a futures contract or an options contract, there's two people on both sides of the trade. There's a buyer and there's a seller, and the next tick is going to make one of them a winner and one of them a loser, right off the bat. If you and I enter into a trade at 10, okay? We enter into a trade at 10. It means that you, in essence, if you're the seller, let's say you sold them at 10 and I bought them at 10. The next tick is going to make one of us a winner and one of us a loser. If the next tick is 9, the amount of money that flows into your account is coming directly out of mine. Are you guys with me on this? If the next tick is 11, the amount of money flowing into my account is coming directly out of your account. Okay? So basically what you have is you have two diametrically opposing beliefs entering into every single trade. Every trade that is made, there are diametrically opposing beliefs about what the future is going to be. So again, I'm going to say, what would cause anybody to buy high or sell low? Just conviction. In other words, what you have is a situation where if someone's willing to bid a market up to the next highest price, basically what that person is doing is that person is stepping out, saying that my conviction that the price is going to go to 12 or beyond is so great that I am willing to do the opposite of what I need to do to make money. Think about what I just said. I am willing to do the opposite of what I need to do to make money because my conviction is so strong that the next price will be 12 or 13. Otherwise, this person would wait. If this person thought the next price was going to be 9, then they'd buy lower. If they thought it was going to be 8, they'd buy low. They'd wait and buy lower. Whereas, so what happens is that the person who's willing to bid a market up and take out these offers at 10, take out all the offers at 10 and bid it up to 11, has to have a stronger conviction in the future than the person who sold it to him at 11. Because this person is creating price movement, is actually creating movement, and the person on the other side of the trade is being passive because they're doing exactly what they think they need to do, and that's sell high relative to the last price. Are you guys with me on this? Okay, everybody understand it? Now, I want to ask you, is there anybody in this room who has purposefully bid up a market? There are? There are some people who've actually bid a market up? In other words, the people who've actually taken the offers, all the offers out at the next highest price and bid it up? Do people like that exist? Yes. So in other words, we are aware of the fact that there are traders who both have the financial and the psychological resources to actually purposefully bid markets up or offer them lower. We're together on this, right? Okay. So basically what you have is that all price movement has to be a result of an imbalance in the degree of conviction between the traders who believe that prices are going up and those who believe that it's going down. That is the only way that prices move. It doesn't matter what the reasons are that people tell you about why they did what they did. Or it doesn't matter what the reasons that you hear on CNBC or whatever about where the market is and why it went the way that it went. Ultimately, it all boils down to an imbalance in conviction. That's the only way prices can move. Because the only way they can move is for someone to actually purposefully bid it up or offer it lower. And for them to do it, there has to be, like a sense of strength in terms of energy in their belief that the next tick is going to make them a winner.